Ladies and gentlemen, welcome back to the channel. In this video, as always, as we typically do on Sundays, we're going to be going over your week ahead, the big catalyst coming as far as earnings, economic data, and geopolitical. We know we have the Trump-Putin meeting on Friday, which could be important, but I think things are really shaping up for that to become less of a headwind for markets, and I'll explain why that is here in this video. So an exciting week ahead. Hit that like button and subscribe to the channel if you have not done so already. Check out that link down below in the description of this video if you want to come join the private trading group, where essentially we're going out and finding small cap AI stocks before Wall Street does. Okay, before they're, you know, the next quote unquote meme stock. We're going out and investing in the quality companies that Wall Street is overlooking. And one particular stock I own about $80,000 in, and I think that's a 10, 20, 30, 40, 50x opportunity in the coming years. And we take a medium term time horizon, like 1 to 3 years, on most of these investments as kind of a bare minimum to give them time to work. So yeah, if you guys want to come join it, check it out. Link down below in the description of this video. But with that said, on to today's episode. Now, in broader market news today, JD Vance on punishing China for Russia oil. He says that Trump is thinking about it. He says that China is more complicated than India. China wants the U.S. to relax export controls on chips as part of a trade deal. According to a White House official, Trump is open to a trilateral summit in Alaska with Putin and Zelensky. For now, White House plans a bilateral meeting as requested by Putin. And European leaders are calling for Ukraine talks to include security guarantees. Zelensky says he stands firm on clear Ukrainian positions. Again, we talked about this yesterday on the channel. Zelensky doesn't want to give up any of Ukraine to Russia, and that's just obviously not logical to get this conflict over with. There's going to have to be a concession. Now, from a market's perspective, if Zelensky's the reason this war continues or doesn't want to, you know, cede territory or make a concession, okay, I think that takes the pressure off of Russia. Thus, that takes the pressure off of Trump to issue secondary tariffs on countries that buy Russian oil, like China. I don't think China's going to get a tariff put on them because the war in Ukraine is still going on if Putin and Trump are actively trying to end it and Zelensky is not willing to budge at all, right? So I think from a market's perspective, if Zelensky, you know, goes into that meeting, you know, with the positions that he has now, I think that could actually be a very positive outcome for the markets. Now, apparently the JD Vance and Europe allies had a meeting, and this meeting yielded progress according to a U.S. official. Now, Bowman said that payroll growth is likely to sharply slow due to significant softening in the labor market. Keep in mind, Bowman is team Fed rate cut. So she's a more dove at this current moment. Bowman sees deregulation, lower taxes, business-friendly environment likely to offset tariff-related effects on economic activity and prices. Bowman says delayed action risks further labor market erosion, indicating a need for a possible bigger cut. And Bowman sees core PCE inflation moving much closer to 2% target than the data shows. Bowman says increased risk to inflation and more confidence that tariffs will not lead to prolonged inflation. Fed Bowman says the latest job market data reinforces my forecast for 3 rate cuts this year, which is the highest likelihood is 3 rate cuts. Okay, but you're pricing in 1 for September, 1 for October, and December. Technically, you got to be above 50% to say, hey, we're pricing in 3 rate cuts. You're not there yet, but the largest percent is favoring 3 rate cuts at 44.2%. The odds of 2 rate cuts by December 10th at 42.5%. So we'll see what happens following these comments over this weekend when we start trading tomorrow. If the markets assign a greater probability of 3 rate cuts based on what Bowman said. And Bowman says housing demand seems to be the weakest since the financial crisis. Now, we are going to have some earnings for this week tomorrow morning. Monday.com, pretty accurate to report on Monday for sure. Barrick Gold, Village Farms, some other names. Monday and after hours, Big Bear AI, Oklo, AMC, AST Space Mobile, Archer Aviation, Microvast, Plug Power, and GoPro. Tuesday pre-market, Circle, C, Pony AI, Kopin, PaySafe, Cardinal Health. Tuesday and after hours, CoreWeave, Rigetti, Kava, H&R Block, and some others. Wednesday pre-market, Arcos, Dorados, Brinker, some random names. I honestly haven't heard of a lot of these companies. Wednesday and after hours, Cisco, Equinox Gold, D-Local, Red Robins, and some others. Thursday pre-market, JD.com, John Deere, Advanced Auto Parts, Birkenstock, and Weibo. And then Thursday and after hours, Applied Materials, New, and Gambling.com. A lot of random companies, but you do have, some AI names, some high-flying AI names as of recently, like Circle, like CoreWeave, okay, Pony AI, another one, Oklo, Big Bear AI, Archer Aviation, right? There is this aspect of like smaller AI companies that are going to be reporting over the next couple of weeks, including some of the ones that we own in the trading community. I do think August is, at least the rest of the month, is going to be very portfolio specific. Like whatever happens in the broader markets, that's one thing, but there's going to be a lot of the stocks that we invest in reporting earnings throughout the rest of August. So be prepared for some large portfolio moves, even if the broader index does not move all too much. Now, even beyond earnings, the big story is going to be economic data for this upcoming week. So tomorrow, it's going to be a relatively slow day. You have a 3-month, 6-month bond auction, not a whole lot going on there. Tuesday, you have your CPI report. So core month over month is expected at 0.3%. Last month was 0.2%. So you're expecting a hotter inflation number. If that comes in low, like 0.2%, that's money. Okay. Stocks are going to react very favorably to that. Now, I do want to pay attention to what happens tomorrow, because if Wall Street kind of gets leaked, if you will, the CPI report, tomorrow could be an unusually strong day as well for markets. So I will be paying attention to tomorrow just to kind of get a feel of how inflation could come in. If you come in at 0.3%, that is not the end of the world. Anything higher than that would be problematic. But hey, what if we come in really low? That's where things could get pretty exciting in markets. Now, core year over year is expected at 3%. Last month, it was at 2.9%. So a little bit of a rise expected there, but nothing too crazy. Headline month over month expected at 0.2%, actually down from last month being at 0.3%. And headline year over year expected to rise to 2.8% from 2.7% last month. So again, core is what really matters. And if we can have that month over month number come in lower than expected, that is where the money's going to be made in markets coming on Tuesday. Now, Fed Barkin will speak at 10 o'clock in the morning. Fed Schmidt will speak at 10:30 in the morning. And that is it for your Tuesday. On Wednesday, you get Fed Barkin that speaks at 7:30 in the morning Eastern Standard Time. Of course, Fed Goolsbee that speaks at 1 p.m., but that's it. On Thursday, you get PPI month over month expecting 0.2% month over month. Last month was 0%. Same exact expectations for core month over month as well. So that could be important, but usually Wall Street pays a lot more attention to that CPI report, even if theoretically, like PPI should lead before CPI. So if we're going to have tariff inflation, you would think that PPI would see that rise before CPI theoretically, right? Because PPI is producer price indexes or producer price index or producer price inflation, which that is like company level inflation. CPI, consumer price index, is the consumer level. Okay. You will also get initial jobless claims expecting about 227,000. Last month was 220, or last week was 226,000. So a little bit of a rise expected there as well, but nothing too crazy. Fed Barkin will speak at 2 p.m. And that is it for your Thursday. On Friday, you get retail sales month over month for July, expecting positive 0.5%. And here's the deal with retail sales. You want it as positive as it can be, right? There's really no such thing as a too high number for retail sales. The only risk is that it comes in too low, and then you have more of those growth concerns and or potentially recession concerns, right? And that is the last thing we want during a bull market. Now, you will get export prices and import prices month over month as well. Not going to be as important. New York Empire State Manufacturing Index, again, not going to be as important. A lot of smaller data sets as well. You can see this whole list here related to retail sales and export and import prices. So be mindful of that. Although none of these single, data sets here that are highlighted are going to change much. It could definitely add to the narrative. Okay. Now, Friday at 10 o'clock in the morning, you get Michigan consumer sentiment. Preliminary numbers for August. The headline number is expected to rise from 61.7 last month to 62.1. So you're expecting a rise. 5-year inflation expectations are expected to rise from 3.4% to 3.6%. Okay, so that's not great. Consumer expectations are expected to weaken from 57.7 to 57. Not great. Current conditions are expected to weaken from 68.0 to 67.5. Not exactly great. And 1 year ahead inflation expectations are expected to rise from 4.5% to 4.8%. So not exactly great there as well, which just, when data is expected to be really good or really bad, you always have a greater likelihood of surprising in the other direction. So Michigan consumer sentiment is expecting pretty bad numbers. I wouldn't be surprised if we get a positive surprise here and actually get some maybe better than expected numbers. But overall, I've talked about this on the channel for a while now. I have been expecting some chop, like a 2 to 3% down move, and then to chop around for a while until we head into the end of the year and get a lot more bullish on markets. Now, S&P fell about 3.3%. You're almost back to new all-time highs again. You're only down around 0.5%. That's not a lot of chop. It was basically straight down and right back up again. Don't be shocked if we do go through some chop this week. If perhaps the CPI report is high and we get this back and forth kind of chop. Okay, that's what I'm expecting. I'm still expecting that. Although, again, I wouldn't be surprised if stocks just break out higher from here. Like you shouldn't be shocked if anything happens here. For markets to continue to rip higher or to come down and chop around. I do think the downside is pretty limited unless something new dramatically happens. Unless there is, tariffs put on China for buying Russian oil, unless there's something else that happens that we're not already accounting for, it's hard to see material downside. It's again like you're going to the dentist, okay, and you think you need freaking dentures, right? That's like the reference to nuking trade with China. Like it was done, 3-4 months ago. There was an embargo with China. Again, for this analogy's sake, thought you needed dentures, and now you're like, okay, you go to the dentist and they say you only need a root canal, dude. You're fine. You're gonna keep your teeth. That's still not great. That's still gonna suck, okay? But it's a lot better than what it could have been. It's gonna be hard to scare you at that point, right? You already accepted the worst possible outcome. Like, you need something else to materially change in markets at this point to get that extensive downside. AI is not going anywhere. CapEx is not going anywhere. Earnings are holding up. I mean, trade can be volatile, but it's gotten a lot better with trade deals seemingly getting close to being completed. Inflation, not really around. There's not much inflation to speak of. Economy weakening a little bit, but I think we're past the point of, like, you know, seeing a substantial weakening in the economy. I don't see that as happening at this point. So be mindful of that. We are in a seasonally weak period for markets, just to put that out there if you did not already know. So again, don't be surprised if anything happens. Hit that like button and subscribe to the channel if you have not done so already. I do think as well, I will point this out, that I think the Russell has a lot more upside into the end of this year, into 2026, even than the headline S&P, because big tech has really dominated the show. But especially once we start to get rate cuts, once we start to realize the economy is not at risk any more than it normally is of going into a recession, I do believe you're going to see small caps really outperform. And you're still down on the IWM, the Russell 2000 index here, about 10.5% from all-time highs that you set after the election in November. Like, yeah. When anyone says the markets are frothy, quote unquote frothy, like they like to say, just look at the Russell. Like, it's not what I would categorize as frothy or overextended. So check out that link down below in the description of this video if you want to come join the trading community. Nonetheless, have a great rest of your day, and I will see you in the next one.